Welcome, everyone, and thank you for joining us today for our program, Antitrust Considerations in Middle Market Transactions. My name is John Bliley, and I'm a partner in the firm's M&A acquisitions team, and I'm based in the Richmond office. Today, I'm joined by my colleague, Jim Burns, who is the chair of the firm's Antitrust and Trade Regulation Practice Group and is based in our Tyson's office. Before we start, a couple of housekeeping items to go over. First, at any point during the presentation, you may submit questions by using the Q&A button at the bottom of your screen. Time permitting, we will address questions at the end of the presentation. If you are having any audio or technical problems, please use that same Q&A button and our marketing team will work to get those resolved. Finally, you will receive a copy of the presentation materials and a link to the recording by email later today, so there's no need to write anything down. So let's jump in. Jim, there's been a lot in the news about the FTC and DOJ and antitrust issues. So what's going on? What are the changes at the FTC and DOJ antitrust division that have impacted merger review recently?
Well, there really is a lot going on in the antitrust merger space, John. When President Biden took office, shortly thereafter, he issued an executive order in 2021, and he directed the DOJ and the FTC to really step up their merger enforcement. And they, in fact, have really been doing so since that directive. And as transaction volume decreased a bit through 2022 and now into 2023, it's provided an opportunity for the regulators to look more closely at not only larger deals, but middle market deals as well. And they are most assuredly doing that.
Has there been sort of a change in what the regulators are looking for and in terms of their analysis of any competitive issues?
Been some very significant procedural changes that have accompanied their greater interest and focus on these deals. Some of them include, for example, the termination of early termination letters. An early termination letter was a letter that the regulators would typically send in less than the 30-day period for review, indicating that there were no significant antitrust concerns, and that would allow the merging parties to move forward. Those early termination letters have been suspended. They don't appear to be coming back anytime soon. And so now all parties are required to wait at least that 30-day period. Other procedural changes include the withdrawal of the horizontal merger guidelines that used to provide a roadmap for merging parties on whether a deal was likely to gain any interest or concern at the regulator level. And then finally, even after your 30-day waiting period, another significant change that the regulators have implemented in the last year or two is the issuance of close at your own risk letters, which indicate not that there are no concerns and go forward, but instead, we haven't completed our review. We know statutorily that we can't hold you without taking action. So therefore, go forward, but don't take this as a sign that we necessarily have no concerns. That's really been a development that has caused ripples and concern in the M&A community going forward.
That's interesting for sure. And are there any sort of non-traditional areas that the FTC DOJ are looking at in terms of raising red flags for transactions that they didn't used to?
In addition to just looking at more deals, the issues that they're looking at have expanded. Most significantly, the regulators in the last year or two have really put an intense focus on the impact of transactions on employees. That was something that typically was not a focus in merger review in years past, but particularly if a transaction is going to result in a number of employee layoffs, for example. The regulators seem to have a significant interest on whether employee markets could be adversely impacted by a merger. And they have, in fact, slowed down mergers to review issues like that over the last 18 months to 2 years.
That certainly will have rippling effects for deals across the spectrum. I guess, moving into the middle market space, how have these changes implicated and impacted these deals?
Well, as I mentioned earlier, with the somewhat lesser deal volume more recently, it has opened up the opportunity for the regulators to focus on middle market deals, where traditionally almost all of the attention was being placed on the really super large deals. We are not seeing that as the case now. Middle market deals are getting a lot of attention as well, particularly in certain industries and certain focuses. For example, President Biden indicated in his executive order not only that merger review should be increased, but to focus on certain industries, for example, healthcare and private equity transactions. And so to the extent that the middle market transactions involve those industries, we're seeing really significant increased review and enforcement.
And real quick, when you say increased review, what does that mean? Does it, are we talking sort of months, years? How long is the delay? What's the general impact?
Sure. When we're talking about Washington, D.C. and regulators, the answer, of course, is always it depends. But the 30-day window for most middle market deals, where after that 30 days, the parties could be pretty confident that their deal would be approved and they wouldn't have to think about antitrust. We're now seeing requests for additional information. We're getting requests that the parties hold their filing and refile to give a little bit more time. So what was normally a 30-day window at most, and then the middle market transactions were quote unquote done with antitrust, is extending a little longer than that. And obviously the deals that the regulators decide do have at least potential issues could allow for an extension of a review for several months.
In addition to timing, what sort of implications does a review that you just described have on a deal and the parties?
Well, sure. Obviously, the parties want to have approvals as quickly as possible, and any delay in the deal increases both the costs and the risks for the merging parties. As I said earlier, middle market transactions really were not the focus of merger review in the past. And so this is really a new phenomena that parties seeking to do transactions in this space are more likely to face some trouble, added costs, and added risk.
With that being said, I guess how can middle market deal players sort of plan ahead and reduce the risk to address, the regulatory delays or, oppositions to the deals that they may not have previously had to deal with?
Right. Well, recognizing now that if your transaction is Hart-Scott reportable, if it's of a size currently over $111 million, and you have to file a Hart-Scott, recognizing that you will have a delay of at least 30 days, suggests that the merging parties should file their Hart-Scott as soon after they are confident that the deal will go through as possible, so as to get the clock running, if you will. You can file simply on a letter of intent. You don't have to wait until a definitive agreement is actually signed. And so again, in transactions where the parties are quite confident that the deal is likely to go forward, that would be a recommended course. One change in the antitrust merger space that actually is beneficial for the middle market transactions is that the lowest threshold level of filing fees was actually reduced. And so it now is the lowest level of filing fee is $30,000 rather than $45,000. frankly, that serves as cold comfort for many clients. But it is at least one small positive in the whole panoply of changes that are being undertaken by the merging agency, the merger authorities at present.
Is there anything else that you can do, sort of, reaching out to third parties or otherwise to generate support for your transaction? Ways to just get that out in the open early on?
That's always a very desirable tack to take in any transaction where the parties do believe there is a possibility that there could be competitive consequences or concerns at the regulators about the potential competitive effects of a deal. You do want to reach out to your customers, to the community, getting letters of support. And frankly, that's important because the principal way that the regulators learn about deals, particularly middle market deals that aren't quite as highly publicized as the mega billion-dollar deals, is through complaints. So the absence of complaints is a recipe for a likely clean, easy, simple, and quick approval process with the regulators, and that's obviously what you want.
Indeed, and that would apply for both reportable and non-reportable transactions, do you think?
To some extent, I think you want to think through how likely someone is to complain on a non-reportable deal. On a non-reportable deal, if it's a small enough deal that it's not likely to get any press and no one is likely to know about it, your strategy might change. But certainly, if a deal is going to be publicized and if you're going to have to do a hard Scott, you do want to get community support, because even if only a threshold investigation is conducted by the regulators, they're going to start calling customers and competitors to ask about their views on a transaction. So the transaction is going to become known, and you do want to have the benefit of good support for your deal.
Great. So moving on to questions, it looks like a quick question we have. There's been rumblings in the news and just in the press in general that maybe the antitrust authorities have gone too far in their current efforts, and it's having a negative impact on business and transactions and commerce. I guess, what are your thoughts on that, and where do you think we're going?
Yeah, there certainly have been some arrows shot, if you will, at the regulators regarding the manner in which they are engaging in merger review. A few months ago, when Commissioner Phillips left the FTC, he bemoaned the fact that, in his view, the agency was taking an ill-advised view on mergers. He thought that there was too much focus on mergers that didn't have competitive implications, and he characterized it as an inappropriate tax on merger transactions, which he thought was completely inappropriate. Even more recently, Senator Cruz sent a letter to the FTC, again complaining that it appeared that the FTC was focusing on transactions that it shouldn't, and if in fact they were focusing even on transactions that didn't create antitrust risk, that was really inappropriate for the merging parties, and it would be slowing down commerce. So there has been some pushback from various circles to what the regulators are doing at this point, and it'll be interesting to see going forward whether those complaints, if you will, have any impact, particularly as we expect to see some new additions to the commissioner ranks at the FTC. There's only 3 of the 5 appointed commissioners right now, so 2 are likely to come on board in the next several months.
Well, looks like we're out of time for the day, and just want to thank everyone for joining us, and Jim for all of your insight. And if there's any other questions that we didn't get to, we'll reach out to you directly. And thank you for joining us, and have a great day.
Thank you, John. Have a great day, everyone.